Hello, friends. What if I told you that in just one night the market erased $19 billion? Thousands of traders got wiped out. Some lost everything, while others made tens of millions within minutes. How did this happen? Was it a glitch, a setup, or someone's calculated play on liquidity? Today, we'll break down who really pressed the button, how it was orchestrated, and most importantly, how to reduce your risks when something like this happens again.
3, 2, 1, fire!
Friends, before we dive into the market analysis and potential coins, please note that this video is not financial advice. It only reflects my personal view and understanding of the market. Always do your own research and invest wisely. What happened on Friday was a real market meltdown that many didn't even have time to comprehend. Within a few hours, over $19 billion in positions were liquidated. Bitcoin dropped nearly 10%, while altcoins crashed 30 to 40%. Just imagine, you open your chart, and instead of your portfolio, there's emptiness. This wasn't regular volatility. It was one of the biggest short squeezes and leverage flushes the crypto market has seen. So what actually happened? It all started with a headline. The Trump administration announced 100% tariffs on Chinese imports, a bombshell that instantly shook global markets. Investors took it as a signal of a looming recession. Capital fled, liquidity tightened. But just as everyone thought it would be a small pullback, all hell broke loose. Within minutes, Bitcoin broke key support levels, triggering algorithmic liquidations and margin calls. The domino effect followed. Altcoins like Solana, Avalanche, Arbitrum, even large caps, plunged 30 to 40%. This wasn't organic. It appeared almost coordinated, impacting everyone from small traders to major funds. At one point, over $560 billion in total market capitalization evaporated, and exchanges began showing anomalies no one had ever seen before. On Binance, for instance, prices broke. Assets like USD, WBETH, and BNSOL temporarily depegged from their base values. On some pairs, USDE dropped to $0.65, creating the illusion of a total collapse. That's when the liquidation cascade began. The system treated collateral as devalued and started wiping traders' positions one after another. But here's the detail the entire industry is talking about. Just 30 minutes before the tariff announcement, a massive short appeared on Hyperliquid, and not by accident, it was opened while the market still looked stable. Later, it turned out the trader made $192 million in profit, and he wasn't the only one. And now the main thing, don't switch off, because in the second part, I'll show you what exactly broke in the system, and why it's much more dangerous than just a market crash. So make sure to watch this video till the end and subscribe to the channel so you never miss these breakdowns again. But that's not even the most important part. What broke this time exposed a weakness in the very architecture of the market. And in the next part, I'll show you something far more serious, something we've never seen before. This wasn't just a technical glitch, it's a signal that the market we know might no longer be safe, even for those who did everything right. So stay tuned, because next, I'll show you exactly how it happened on a technical level and how you can prepare yourself for anything in this market. So, friends, now it gets interesting, because what we saw on Friday doesn't look like a coincidence. Yes, officially it's being described as market turbulence, a liquidity flush, or the Trump tariff effect. But more and more analysts and traders are starting to believe it could have been a coordinated attack on the weakest point of the entire system, Binance's pricing mechanism. Let's start with the facts. Binance admitted a flaw in its own collateral valuation model. Instead of using objective prices from oracles or redemption mechanisms, the system relied on data from its own order book. That means if someone with deep liquidity started deliberately pushing certain assets down, the exchange itself would begin to believe in those artificially low prices. And that's exactly what seems to have happened. Someone started massively selling USDE on Binance, roughly between $60 and $90 million worth. At the same time, pressure hit Ethereum and Solana, the key wrapped assets on Binance Smart Chain that were used as collateral in the Binance Unified account. When the prices of these assets dropped, the system automatically began liquidating users' positions, assuming the collateral was insufficient. But the worst part, it all happened within 20 minutes. No exchange was prepared for that kind of speed. Now for the real story. On-chain data shows several wallets acting suspiciously alike. One of them, the same one I mentioned earlier on my Telegram, quietly moved $80 million to Hyperliquid, opened a 3,500 BTC short, then another $240 million in ETH shorts. A few hours later, the crash began. As Binance liquidations spread across the market, this trader started taking profits, around $200 million net. Either he had inside info or his timing was supernatural. But it doesn't end there. After closing, he opened new shorts, 1,800 BTC worth another $200 million. I actually wrote about this yesterday in my Telegram channel. I'll leave a link to that wallet below the video. You can check everything yourself via Hyperscan or Hyperliquid. This isn't just some random anon, it's a trader with massive capital, moving in perfect sync with global events. That's why many believe this could have been an insider, someone who either knew about the changes in Binance's system or had connections with major funds. I shared this exact wallet in my Telegram before major media picked it up. If you're not following yet, now's the time, because I post this kind of data in real time. If this video gets at least 10 comments asking for wallet tracking, I'll make a full guide on how to track whales and spot their moves before the market reacts. Because mastering that skill gives you a real edge. You start seeing where the smart money moves before everyone else does. Back to the main story. Binance later launched $283 million in compensation for users whose positions were liquidated due to the pricing bug. They also changed their wrapped asset valuation model. Now it's based not on spot prices, but on conversion ratios, factoring in staking and intrinsic token value. In short, they patched the hole that likely caused the chaos. But one timeline detail still raises eyebrows. October 6th to 14th. On the 6th, Binance announced the new model, but it wasn't activated until the 14th. And right in that 8-day window, the crash happened. A coincidence? Hard to believe. Athena, whose USD token was at the center of it all, confirmed there was no systemic depeg. Off Binance, the token held steady. Redemption worked fine. Meaning, the chaos existed only inside Binance, and that's what makes this case even more alarming. Because this wasn't just a price crash, it exposed serious weaknesses in the market's architecture. If someone can break the system not through code, but through its logic, that's a whole new level of warfare. The takeaway is simple. In crypto, you need to understand more than charts. You must see structure. Track whale wallets, follow capital flows, and watch where the smart money moves. That's how you stay ahead. As for futures, be cautious. Even with perfect risk management, events like this can wipe out anyone using leverage. On spot, things look calmer, and personally, I'm still optimistic. Personally, I think the market still has room to grow into 2025 if conditions stay favorable, unless Trump's trade war drags into a long-term trust crisis. Because if this cycle has taught us anything, it's that in crypto, survival isn't about catching the bottom. It's about understanding where large capital flows are moving early. Yesterday, on Monday, the market finally took a breather after Friday's chaos. Bitcoin rebounded to $115,000. ETH gained a few percent, and SOL, XRP, and other altcoins added around 8 to 10%. But this isn't a full reversal. It's just a technical recovery after the $19 billion in liquidations. In the US, the government shutdown continues, 13 days without funding, while Trump's tariff war with China still worries the markets. However, the rhetoric in Washington has slightly softened, and stock indexes have moved higher, especially the tech sector and chipmakers. The total crypto market cap remains $500 billion below its peak, but the panic has eased. Bitcoin's open interest has grown to $26 billion, and the basis has returned to 6 to 7%, signaling that the market is becoming balanced again. Binance confirmed the technical issues, paid $283 million in compensation, and switched to a new asset valuation system to prevent similar depegs, which can be seen as a fairly positive resolution to the situation. Funds are calm. Inflows into Bitcoin ETFs show that institutional trust remains strong. Altcoins have bounced, and traders are already calling it a healthy market reset. But despite this rebound, the market is still fragile. The shutdown, tariffs, and low liquidity remain the main risks. And the coming days will show whether this is truly the start of a recovery or just a short pause before another hit. And that's all for today. Remember, this is just my personal view of the market, not financial advice. Always do your own research before investing. Thanks for watching. Don't forget to like, subscribe, and stay tuned for more market breakdowns. See you soon.